Hello and welcome to the Financial Accounting and Business English course brought to you by London College. My name is Imad Abdelhamid and I will be your instructor in this course. This course has 5 sections. Section 1, Accounting and Bookkeeping. Section 2, Banking and Financial Services, such as loans, deposits, and credit. Section 3, Investment and Personal Finance, such as stocks, bonds, mutual funds, retirement accounts. And Section 4, Corporate Finance, such as mergers, acquisitions, corporate restructuring, and financial planning. And finally, we have Section 5, which is a review for the course. Our first lesson is an introduction to financial English vocabulary. Financial English vocabulary is a fundamental component of communication in the world of finance and accounting. To succeed in this industry, it's essential to have a good understanding of financial terms and phrases that are commonly used in financial reporting, analysis, and management. This course will provide you with an introduction to financial English vocabulary, covering key terms and phrases related to finance, business, investment, and accounting. You will learn how to identify and use financial terms in different contexts, including financial statements, reports, and conversations. Throughout the course, you will also have the opportunity to practice using financial English vocabulary through exercises and activities that reinforce your learning. By the end of the course, you will be able to demonstrate your understanding of financial English vocabulary and apply it to real-world scenarios. We will also be looking at financial and investment concepts and terms. Whether you are a professional working in a finance and accounting or a student looking to improve your language skills, this course will help you develop your proficiency in financial English vocabulary and enhance your communication skills in the finance industry. So we will start by our first lesson, Lesson 1, Introduction to Financial English Vocabulary. And now we will get to know some key terms related to accounting and bookkeeping, including assets, liabilities, equity, revenues, expenses, and net income. Pay attention to the pronunciation. See how I pronounce them. Assets, liabilities, equity, revenues, expenses, net income. Perhaps you could pause the video now and practice pronouncing them yourself. To make this course interactive, what I would like you to do is to take notes of the definition of each of the terms before I tell you what they mean. So guess what this word means. If you've ever seen this word before, what do you think it means? Think about the definition of each of these words and take a note of them on a separate notebook. Then, when I start defining them, compare your definition with mine. And if for each one that you get correctly, give yourself a point. Okay, we will do this for the entire course. So I want you to get used to this practice. Okay, so for every time I will define a word, I want you to pause the video, think about the word, and then write the definition on a separate piece of paper, then compare it with mine. All right, so let's get started. The first word we have here is the word assets. Assets are resources that a company or an individual owns or controls that are expected to provide future economic benefits, and they include cash, accounts receivable, inventory, property, plant and equipment, investments, and an example for this word in a sentence. The company's asset included cash, accounts receivable, and inventory. All right, now what I'd like you to do, try to use that word in a sentence. So make a sentence of your own using that word. pause the video now, and then do this practice for each single word we will explain together. This is to make sure that you are actually practicing the words that you're learning and that you are engaged in the course. We will now move on. The word liabilities. Liabilities are obligations that a company owes to others and are expected to be settled in the future by transferring assets, providing services, or other similar transactions. Examples for liabilities could be accounts payable, loans payable, accrued expenses, deferred revenue, and bonds payable. Let's see this word being used in a sentence. The company's liabilities included loans payable, accounts payable, and accrued expenses. Similar to what we did previously, what I'd like you to do is to try to use this word in a sentence of your own. You now know what it means, you now know how it's pronounced, so now let's try to practice using that word in a sentence. So I want you to create a sentence using that word. Equity. Similar to what we did previously, first of all, notice how I pronounce it. Then pause the video. Try to define the word if you know what it means in your notebook. Okay? So equity is the residual interest in the assets of an entity after deducting liabilities. Examples for equity could be common stock, preferred stock, retained earnings, and treasury stock. Let's see this word being used in a sentence. The company's equity was composed of common stock, retained earnings, and other equity accounts. Revenues. Revenues are inflows of economic resources resulting from the sale of goods, rendering of services, or other activities that constitute the entity's ongoing major operations. Examples for revenues could be sales revenue, service revenue, interest revenue, rental revenue, and royalty revenue. Let's see this word in an example. The company's revenues came from sales revenues, service revenues, and interest revenue. Expenses. Expenses are outflows or other using up of economic resources incurred in the entity's ongoing major operations to generate revenues. And they include cost of goods sold, salaries and wages expense, rent expense, utilities expense, advertising expense. Let's see the word expenses being used in a sentence. The company's expenses included salaries and wages, rent, utilities, and advertising expenses. Net income. Net income is the amount of profit or loss that a company generates after deducting expenses from revenues. Net income, also called net earnings or profit, is the amount of revenue left over after deducting all expenses, taxes, and other costs. For example, a company with $500,000 in revenue, $300,000 in expenses, and $50,000 in taxes would have net income of $150,000. Let's see this word being used in an example. The company's net income was calculated by subtracting its total expenses, taxes, and other costs from its total revenues, resulting in a profit of $100,000 for the year. Okay, what's next? I've prepared some activities for you to do. So there is an exercise, and I would like you to do your best in the exercise. There's a little quiz and an assignment, which is an extra activity, just basically to get you practice using those terms. Okay, so good luck with the quiz, and I will see you in the next lesson. Welcome again in lesson 2, Introduction to Financial Statements. So what do you mean by financial statements? What do you think financial statements are? Take a note of the definition if you know what it means. Okay, so financial statements are documents that show the financial position of a company over a specific period of time. These documents are used by business owners, investors, and other stakeholders to understand how a company is performing financially. There are three main financial statements: balance sheet, income statement, and cash flow statements. Have you ever come across any of these? If you work in the finance industry, or if you work in a bank or in a company in the accounting department, you probably know what they mean. So let's see what they mean. But before I show you their definition, please try to define them um, before I define them for you, and take a note of your definition, then compare it with mine. Balance sheet. We'll start with the first one, balance sheet. The balance sheet shows the assets, liabilities, and equity of a company at a specific point in time. This statement helps to give a snapshot of a company's financial position and its ability to meet its obligations. The next one is the income statement, also known as the profit and loss statement, shows the revenue and expenses of a company over a specific period of time. It helps to show the profitability of a company and whether it's making a profit or loss. The cash flow statement shows the inflows and outflows of cash within a company over a specific period of time. It helps to show the liquidity of a company and its ability to meet its short-term financial obligations. Understanding financial statements is essential for anyone involved in finance, accounting, or business management. It provides insights into a company's financial health and helps in making informed decisions. All right. Next, you will see some more examples, so please read those examples that are provided for you and complete lesson 2 quiz. I'll see you in the next lesson. Hi again. This lesson is about key financial terms and vocabulary. In the previous article, you were introduced to some key terms that you would see on financial statements. In this lesson, we will define key financial terms and vocabulary related to financial statements, including liquidity, solvency, gross profit, net profit, depreciation, amortization, and accruals. Notice how I pronounce them. I will repeat them again for you. Liquidity, solvency, gross profit, net profit, depreciation, amortization, accruals. Before I define any of them, can I ask you to do what we did before? Take notes of any of these definitions. If you know any of them, please take a note of them and then compare them with the definitions which I'll provide you in the next slides. We will now define each of those terms. Our first one is liquidity. Liquidity refers to a company's ability to meet its short-term financial obligations using its current assets, such as cash, inventory, or accounts receivable. It measures the ease with which a company can convert its assets into cash to pay its debts. Solvency. Solvency refers to a company's ability to meet its long-term financial obligations using its assets. It measures whether a company has sufficient assets to cover its debts in the event of bankruptcy or insolvency. Gross profit. Gross profit is the difference between a company's revenue and the cost of goods sold. It represents the profit of a company makes from its core business operations before deducting operation expenses. Net profit. Net profit, also known as net income or earnings, is the total profit of a company makes after deducting all of its expenses from its revenue. It represents the final profit a company makes after all costs have been taken into account. Depreciation. Depreciation is the systematic allocation of the cost of a fixed asset, such as machinery or buildings, over its useful life. It's a way to account for the wear and tear of the asset over time and represents the decrease in the value of the asset over its useful time. Amortization is similar to depreciation, but it's used for intangible assets such as patents or trademarks. It's the process of spreading the cost of an intangible asset over its useful time. Our last one is accruals. Accruals are expenses or revenues that have been earned but haven't yet been paid or received, respectively. They are recognized on the financial statements to provide a more accurate representation of a company's financial position and performance. Okay? In the next lesson, I'll provide you with more terms and vocabulary. So we previously looked at some key financial terms and vocabulary. Now we will have more so that you have a wide range of vocabulary to increase your vocabulary. Okay, we now have some more financial terms and vocabulary. The reason why I've provided these vocabulary is that I want you to increase your vocabulary level and to have a wide range of vocabulary in the financial industry. Before I define each of those terms, please, if you know any of them, pause the video now and take a note of the definition that you have for the word or the phrase that you know. If you don't know any, please don't worry. This is why I'm here. I'm here to explain to you what these terms are. All right, we will now define each of those terms. Our first one is EBITDA. This is an acronym and it means earnings before interest, taxes, depreciation, and amortization. Our next one is dividend. And dividend is a distribution of a portion of a company's earnings to its shareholders. Let me give you an example. Microsoft Office pays dividend to its shareholders. They do that, I think, quarterly. So each 3 months they pay dividend for their shareholders. I'm not sure whether they do it quarterly or every 6 months or annually, but they pay dividend for their shareholders. And what the company does is that they take a portion of their earnings and they distribute that to its shareholders. So if you have shares in Microsoft, you might receive the dividend when the company announces it. 3, ROI, again, that's another acronym which refers to return on investment. And it's a measure of profitability that calculates percentage return on a particular investment. Our next one is PE ratio. And again, PE is an acronym for price to earnings. And it's a valuation ratio that compares a company's stock price to its earnings per share. Number 5, assets under management. You could say AUM, which is again another acronym here, assets under management. The total value of assets that a financial institution manages on behalf of its client. Number 6, capital expenditure. And this is money spent on acquiring, upgrading, or maintaining long-term assets such as property, plant, and equipment. Working capital. This is the difference between a company's current assets and current liabilities, and it's used to measure a company's short-term liquidity. We explained what liquidity is earlier. 8, gross margin, and this is the percentage of revenue that exceeds the cost of goods sold, and it's used to measure a company's profitability. The next one is dividend yield, and we defined what dividend is earlier, but dividend yield is the annual dividend payout of a company divided by its current stock price, and it's used to measure the return on investment from dividends. Number 10 is debt to equity ratio, and it's a financial ratio that compares a company's total liabilities to its shareholder equity, and it's used to measure its leverage or financial risks. So far we've defined some really important and common terms and phrases that are used in the finance industry. I'm sure that you found them useful, or I hope that you found them useful. And our next lesson will be a review of the key terms that we have talked about in this section. I'll see you soon. Hi again. This is lesson 4, and it's a review of key terms that we talked about in the previous sessions. Here is a review of the key concepts covered. So, as you can see, we've got 11 questions on the screen. Before I answer them, please try to answer them yourself. So pause the video now and try to define those terms on your own before I define them for you. Again, don't worry, in the next slides, I will talk about each one of them. Our first question is, what are financial statements? Financial statements are documents that show the financial position of a company over a specific period of time. They're used by business owners, investors, and other stakeholders to understand how a company is performing financially. The three main financial statements are the balance sheet, income statement, and cash flow statement. Our second question is, what is the balance sheet? The balance sheet shows the assets, liabilities, and equity of a company at a specific point in time. It helps to give a snapshot of a company's financial position and its ability to meet its obligations. Question 3 is, what is the income statement? The income statement, also known as the profit and loss statement, shows the revenue and expenses of a company over a specific period of time. It helps to show the profitability of a company and whether it's making profit or loss. Next, what is the cash flow statement? The cash flow statement shows the inflows and outflows of cash within a company over a specific period of time. It helps to show the liquidity of a company and its ability to meet its short-term financial obligations. Question 5. What is liquidity? Liquidity refers to the ability of a company to meet its short-term financial obligations using its available cash or assets that can be easily converted to cash. Number 6. Solvency. What is solvency? Solvency refers to the ability of a company to meet its long-term financial obligations. It's a measure of the company's financial health and stability. 7. What is gross profit? Gross profit is the difference between a company's revenue and the cost of goods sold. It shows the profitability of a company's core operations. Number 8. What is net profit? Net profit is the difference between a company's revenue and expenses, including taxes and interests. It shows the overall profitability of a company. What is depreciation? Depreciation is the decrease in the value of an asset over time due to wear and tear or obsolescence. It's a non-cash expense that is subtracted from revenue to calculate net income. What is amortization? Amortization is the process of spreading the cost of an intangible asset over its useful life. It's a non-cash expense that is subtracted from revenue to calculate net income. Now, our last one, accruals. Accruals are expenses that have been incurred but haven't yet been paid. They are recorded as a liability on the balance sheet until they are paid. Well done for completing the first section. We have defined very important phrases and financial terms that hopefully will be beneficial for you in the future, whether you are preparing for your CMA course or tests, or if you are a student studying um, finance or accounting. I think those are very important, and you now have two quizzes to test your knowledge. I'm sure you will do a great job in those quizzes. Good luck for now, and I will see you in the next section. Well done! You've now completed section 1 in this course. By now you should be able to understand and use financial English vocabulary related to accounting and bookkeeping, including financial statements, balance sheets, income statements, and cash flow statements and vocabulary related to them. By now you should also be able to apply financial English vocabulary and concepts to real-world scenarios and demonstrate overall improvement in your proficiency in financial English vocabulary and understanding of financial statements. Congratulations on completing section 1. We will now move on to section 2. Section 2 is about banking and financial services such as loans, deposits, and credit. In this section, you will be working on vocabulary related to banking, financial services such as loans, deposits, and credit. There are 4 lessons in this section. Welcome to our lesson on banking and financial services vocabulary. In this lesson, we will be exploring the language and terminology related to banking and financial services, specifically loans, deposits, and credit. In this lesson, we will be presenting key terms and definitions related to loans, deposits, and credit, and we will be providing examples of how they are used in real-world situations. You will also be offered interactive exercises and quizzes to help you reinforce your learning and gain confidence in using the vocabulary. The learning outcomes of this lesson is introduction to banking and financial service vocabulary related to loans, deposits, and credit, presentation and explanation of key vocabulary words and phrases, and practice exercises and activities to reinforce learning, including matching exercises, etc. By the end of this lesson, you will have a solid understanding of key financial vocabulary related to loans, deposits, and credit, and you will be able to use this vocabulary with confidence in your personal and professional life. So let's get started. Having a strong understanding of financial vocabulary related to banking and financial services is crucial for effective communication in financial context for several reasons. I will share with you 4 reasons here. The first one is understanding financial terminology. Financial terminology can be complex and specific to the industry, and not knowing the language can lead to confusion and misunderstandings. Knowing the correct terminology can help you better understand financial concepts and communicate more effectively with colleagues, clients, and investors. The second reason is accurately discussing financial topics. So when discussing financial topics, it's important to use the correct terminology to ensure that the information is accurately conveyed. Misusing terms or using them incorrectly can result in a misunderstanding of the information being presented, which can have serious consequences. Build credibility. Using appropriate financial vocabulary can help you establish credibility with others in the industry. It shows that you have a deep understanding of the topics being discussed and can effectively communicate your ideas and strategies. Professional development. Improving your knowledge of financial vocabulary can lead to new career opportunities and professional development. Employers in finance industry often look for candidates with a strong understanding of financial terminology and concepts. Overall, having a solid understanding of financial vocabulary related to banking and financial services is essential for effective communication, building credibility, and advancing in the finance industry. Here are some key vocabulary related to loans, deposits, and credit with definitions. Notice how they're pronounced. Loan, interest, principal, collateral, default, mortgage. This word is a bit tricky. Again, mortgage, refinance, APR, annual percentage rate, overdraft, credit score, credit limit, credit report, debit card, savings account, and certificate of deposit. As as we did before I define those vocabulary, please take notes of any definitions that you already know. So if you know any of these words, write the definition on a separate piece of paper and then compare them with the definitions which I'll provide you now. Our first one, loan. Loan is an amount of money borrowed from a lender that must be repaid with interest over a specific period of time. 2. Interest. Interest is the amount of money a borrower pays a lender in exchange for borrowing money. 3. Principal. Principal is the original amount of money borrowed on a loan. 4. Collateral. Property or assets pledged as security for a loan. 5. Default. When a borrower fails to repay a loan as agreed. Mortgage. Mortgage is a loan used to purchase real estate, with the property serving as collateral. 7. Refinance. The process of replacing an existing loan with a new loan, usually with different terms. 8. APR, which is annual percentage rate, is the yearly rate of interest and fees charged on a loan. Overdraft. When a bank account has a negative balance due to withdrawal exceeding available funds, then we call this overdraft. So let's say in my bank account I have £100. If I use my debit card to transfer money or to purchase items that are over £100, then my account will go into overdraft, which means that it will go in a negative balance. So if I use the 150 and in my bank account there's only 100, my account will use the overdraft. So it will be minus 50. It means that I have used more than what I have in the bank account. Credit score. This is particularly common in the UK. I don't think it exists in all countries, but it is definitely in the UK and the USA as well. And it's a numerical representation of a person's credit worthiness based on their credit history. What happens is when you have a credit card and when you use the credit card and you pay your bills on time, and you pay the amount that you owe the banks on time, um, all of this increases your credit score, which means that you're not a risky person. Banks will then be able to lend you money because you proved in the past that you are good at managing your money and finances, and that you're able to pay for um, any debts that you have or had. Credit limit. is the maximum amount of credit available to a borrower. Credit report, it's a report that contains a person's credit history, including credit accounts, payment history, and credit inquiries. Debit card, it's a payment card that deducts funds directly from a current account. Savings account, an account at a bank or credit union that earns interest on deposited funds. Certificate of deposit, it's a savings product that earns a fixed interest rate over a specific period of time. Next is a quiz, so good luck with it, and I will see you in lesson 2. Lesson 2, understanding banking products and services. Banking products and services are financial tools that banks offer to their customers to help them manage their money and achieve their financial goals. Here are some of the most common banking products and services. As we did previously, before I define these terms, I want you to do a little activity with me. I want you to think about the terms and try to define them yourself by taking notes of those definitions in a separate piece of paper. Don't worry if you don't know any of them, I will be explaining them for you in details. Our first one is current account. Current accounts are bank accounts that allow you to deposit and withdraw money on a regular basis. They come with a debit card and offer features like online banking, mobile banking, and bill pay. The next one is savings accounts. Savings accounts are bank accounts that help you save money by earning interest on the money that you deposit. They offer a low risk way to earn a return on your money. Next one is credit cards. Credit cards are payment cards that allow you to make purchases on credit. You can use them to borrow money from the bank and then pay it back later, either in full or in installments. Credit cards can also come with rewards programs such as cashback or points for travel. 4. Mortgage. A mortgage is a loan that you take out to buy a home. The loan is secured by the property we're buying and you make monthly payment over a set period of time. There are different types of mortgages, including fixed rate mortgages and adjustable rate mortgages. 5. Personal loans. Personal loans are loans that you can use for a variety of purposes, such as consolidating debt, making home improvements, or paying for a major expense. They are unsecured loans, meaning you don't need to put up collateral and they typically have fixed interest rates and fixed repayment terms. 6. Auto loans. Auto loans are loans that you can use to buy a car. They are secured loans, meaning the car you're buying serves as collateral for the loan. Like personal loans, auto loans typically have fixed interest rates and fixed repayment terms. Certificates of deposit, CDs. CDs are bank products that allow you to earn a higher interest rate on your savings in exchange for leaving your money in the bank for a set period of time. CDs typically offer higher interest rates than savings accounts, but they also come with penalties if you withdraw your money before the end of the term. These are just a few of the most common banking products and services. It's important to carefully consider your financial goals and needs before choosing which product and services to use. Now we will know more about the key features and benefits of each of those products and services. Our first one is the current account. So some of the key features are that they allow you to deposit and withdraw money on a regular basis, comes with a debit card for easy access to funds, offers features like online banking, mobile banking, and bill pay. They may charge fees such as monthly maintenance fees or ATM fees. The benefits of having a current account is that it provides a convenient way to manage your day-to-day finances, allows you to easily pay bills and make purchases, offers protection against fraud and unauthorized transactions, and can help you avoid the high fees associated with check save cashing services. The next product is saving account. Key features of savings accounts is that it helps you save money by earning interest on your deposits. They typically have lower interest rates than other investment products like stocks or bonds. They may limit the number of withdrawals or transactions per month and may charge fees such as minimum balance fee or excess transaction fees. Some benefits that come with savings accounts are they offer a low risk way to earn a return on your money. They provide a safe and secure place to store your savings. They can help you build an emergency fund or save for a specific goal. They can be used to establish the banking relationship and access other financial products and services. Credit cards. Some of you might already have credit cards, might have used them in the past. So, credit cards allow you to make purchases on credit, which you must pay back with interest. They come with a credit limit, which is the maximum amount you can borrow. They may charge fees such as annual fees, balance transfer fees, or late payment fees. They may offer rewards programs such as cashback, points of travel, or discounts on purchases. Some of the benefits that come with credit cards is that they offer a convenient way to make purchases and build credit. They provide fraud protection and dispute resolution services. They can help you earn rewards, cashback on your purchases. They can also offer interest-free financing for a limited time with promotional balance transfer offers. Mortgages. Mortgages are a loan that you take out to buy a home, which is secured by the property that you're buying. They come with a fixed or adjustable interest rate. They typically have a repayment term of between 15 to 30 years, depending on the bank, depending on the country that you live in. They require a down payment, which is a percentage of the purchase price. The benefits are they allow you to buy a home without having to pay the full purchase price upfront. They can help you build equity in your home over time. And they provide tax benefits as mortgage interest is tax deductible, and they can offer lower interest rate than other types of loans. Personal loans. Personal loans are loans that you can use for a variety of purposes such as debt consolidation, home improvements, or major purchases. It comes with a fixed interest rate and fixed repayment term. It may require collateral or co-signer depending on your credit history and income. And they may charge fees such as origination fees or prepayment penalties. Benefits of taking personal loans are providing access to funds when you need them. They can help you consolidate high interest debt into a single payment, offer a predictable payment schedule with fixed interest rate and fixed prepayment terms. They can be used for a wide range of purposes. Auto loans. Auto loans are loans that you can use to buy a car, which is secured by the car you're buying. They come with a fixed interest rate and fixed repayment term. They may require a down payment, which is a percentage of the price of the purchase price, and they may offer the option to refinance at a later date. Some benefits that come with auto loans is that they provide access to funds to purchase a car when you need it. It offers a predictable payment schedule with fixed interest rates and fixed repayment terms, and it allows you to spread the cost of the car over time. they can offer lower interest rates than other types of loans. Certificates of deposit. This is a bank product that allows you to earn a fixed interest rate over a specific period of time. They require a minimum deposit amount, which can range from a few hundred to several $1,000s, depending on the bank and depending on the product. They may charge penalties for early withdrawal, and they typically offer higher interest rates than traditional savings accounts. Some benefits of certificates of deposit is that they provide a guaranteed return on your investment. They offer a low risk way to earn a higher interest rate than traditional savings accounts. They can help you save for a specific goal, such as down payment on a house or a child college education, and they can be used as collateral for a loan. Home equity loans and lines of credit. This is a loan that allows you to borrow against the equity in your home. It comes with a fixed or variable interest rate. It may require an appraisal of your home to determine the amount you can borrow, and they may require you to have a certain amount of equity in your home. Benefits of home equity loans and lines of credit is that they provide access to funds for large expenses such as home improvements or college tuition. They offer lower interest rates than other types of loans such as credit cards or personal loans. They can be used for any purpose, not just home-related expenses. They can offer tax benefits as the interest may be tax deductible. Overall, the different banking products and services offer a range of features and benefits depending on your needs and financial goals. It's important to research and compare different options to find the ones that are best suited for your individual situation. While different banking products and services offer a range of features and benefits, they may also come with fees and charges that can affect your overall cost. There are some common fees and charges associated with each product or service. For example, current accounts. It could have monthly maintenance fee, which is a fee charged by some banks for maintaining your current account. Overdraft fee. It's a fee charged when you spend more than the available balance in your current account. ATM fees, which is a fee charged by some banks for using an ATM that's not their network. Foreign transaction fee, it's a fee charged for using your debit card in another country. Savings accounts. Some of the fees and charges that are associated with savings accounts are minimum balance fee, so a fee that's charged if you don't maintain a certain balance in your saving account. Excess transaction fee, which is a fee charged if you exceed the number of transactions allowed in a month. Withdrawal fee, a fee charged for withdrawing money from your saving account at a branch or ATM. Credit cards. Credit cards could have annual fees, which are charged every year for having a credit card. They could have balance transfer fees, a fee that is charged when you transfer a balance from one credit card to another. Late payment fee, which is a fee charged when you make a payment after the due date. Cash advance fee, which is a fee charged when you withdraw cash from your credit card. Mortgages. They might have some of these fees. Origination fee, which is a fee charged by the lender for processing your mortgage application. Or appraisal fee, which is a fee charged for evaluating the value of the property you're buying. Closing costs, a range of fees charged at closing, including title insurance, attorney fees, and government recording fees. and perhaps also prepayment penalty, which is a fee charged for paying off your mortgage early. Personal loans. Personal loans could have some fees, such as origination fee, which is a fee charged by the lender for processing your loan application. Late payment fee, a fee charged when you make a payment after the due date. Prepayment penalty, which is a fee charged for paying off your loan early. Auto loans, they could also have, similar to personal loans, they could have origination fee, late payment fee, and prepayment penalty, similar to the definitions in the personal loans. Certificate of deposit. They may have early withdrawal penalty, which is a fee charged for withdrawing money from your CD before the maturity date, or renewal fee, which is a fee charged for renewing your CD at the end of the term. Lastly, the home equity loans and line of credit. They may incur closing costs, which is a range of fees charged at closing, including appraisal fees, title insurance, and attorney fees. Annual fees, which is a fee charged each year for having a home equity line of credit, or a prepayment penalty, which is a fee charged for paying off your home equity loan or line of credit early. It's important to know that depending on the bank and the products that they have, these charges may differ. So not because not because you're taking a personal loan, it means that you will pay all of these charges. Some banks have different charges. They may not ask you to pay any of the charges, depending again on the product. So it's worth checking and reading the contract of any of these financial products before you take them. What's next? So you will have some practice to do, and we will then start lesson 3, which is about vocabulary related to banking and financial services as well. So good luck with your practice, and I will see you in lesson 3. Welcome to lesson 3, key vocabulary related to banking. So this is just an introduction to specialized vocabulary related to banking and financial services, including financial regulations, international banking, and financial technology. Specialized vocabulary related to banking and financial services can include terms related to financial regulations, international banking, and financial technology, and here are some examples. 1. Financial regulations. Compliance. Compliance is the act of following and adhering to laws, regulations, and industry standards to avoid legal and financial consequences. Know your customer, KYC. The purpose of verifying the identity of a customer or client to ensure that they are not involved in illegal activities such as money laundering or terrorist financing. Anti-money laundering, AML. These are measures put in place by financial institutions to prevent and detect money laundering activities. International banking. Some of the specialized vocabulary here could be foreign exchange, also referred to as forex. This is the exchange of one currency for another currency, often used by businesses and investors to hedge against currency risk. International wire transfer. This is a method of sending money from one country to another using electronic transfer systems. International trade finance. This is the specialized area of banking that facilitates and finances international trade transactions between buyers and sellers across different countries. 3. Financial technology, fintech. Blockchain. This is a decentralized and digital ledger that records transactions in a secure and transparent way. cryptocurrency, and you probably have heard this word a lot in the past couple of years with the trend of um, the Bitcoin and other um, digital currencies that we've seen in the past couple of years. So cryptocurrency is a digital or virtual currency that uses cryptography for security and operates independently for a central bank. You also got peer-to-peer lending. So P2P lending is a method of lending money to individuals or businesses through an online platform that connects lenders with borrowers directly, cutting off traditional banks. Next, you have a quiz to do. So good luck, and I will see you in the next lesson. Hi again, and congratulations on completing section 2. Section 3, Investment and Personal Finance, Stocks, Bonds, Mutual Funds, and Retirement Accounts. In this section, we will be exploring key investment vocabulary and strategies, including stocks, bonds, mutual funds, and retirement accounts. Over the course of 4 lessons, you will cover important investment concepts such as risk and return, diversification, asset allocation, and portfolio management. Through practice exercises, quizzes, and assignments, you will gain a practical understanding of how to use investment vocabulary and strategies to effectively manage your personal finances. I look forward to exploring this exciting world of investment with you. Lesson 1, Vocabulary related to banking and financial services. Lesson 1, Vocabulary related to banking and financial services. In this lesson, we have an introduction to banking and financial services vocabulary related to loans, deposits, and credit. The lesson will also include the presentation and explanation of key vocabulary words and phrases, and there will be practice exercises and activities to reinforce your learning. By the end of this lesson, you will have a solid understanding of key financial vocabulary related to loans, deposits, and credit, and you will be able to use this vocabulary with confidence in your personal and professional life. So let's get started. Investing and personal finance vocabulary refer to the terminology used in the field of finance and economics that relates to investing, managing money, and personal financial planning. In order to effectively navigate the world of finance and investment, it's important to have a solid understanding of the key terms and concepts used in this field. Some of the key investment and personal finance vocabulary terms include stocks, bonds, mutual funds, retirement accounts, risk, return, diversification, asset allocation, portfolio management, and many more. This vocabulary will help you to understand the different types of investment available, evaluate the potential risks and returns of these investments, and make informed decisions about managing your personal finances. In the following lessons, we will explore these key terms and concepts in greater detail to help you gain a deeper understanding of the world of finance and investment. Okay, as we did previously, before I define these terms, I want you to guess the meaning of those vocabulary before I explain them to you, of course. 1, asset. I think we defined this previously already. 2, capital gain. 3, capital loss. 4, compound interest. 5, inflation. 6, liquidity. 7, portfolio. 8, risk tolerance. 9, time horizon. And those will be the first vocabulary that we will be talking about in this lesson. All right, so let's see what those words mean. So let's define those words together. The first one is assets. An asset is anything that you own that has value, such as stocks, bonds, real estate, or cash. capital gain, the profit you make when you sell an asset for more than you paid for it. For example, let's say that you bought a house for $100,000 and then you sell that house for $150,000. In that example, you've made a profit because you've sold it more than what you bought it for, which means that you made gain. So this is what we call capital gain. The opposite of this is capital loss. So it's the loss that you incur when you sell an asset for less than you paid for it. Compound interest is the interest that is calculated not only on the initial investment, but also on any accumulated interest. Inflation is the rate at which the general level of prices for goods and services is rising and subsequently purchasing power is falling. Liquidity is the ease with which an asset can be converted into cash. Portfolio, a collection of investments held by an individual or organization. Risk tolerance, the degree of variability in investment returns that an individual is willing to withstand. Time horizon is the length of time over which an investment is expected to be held. You will see that there are a couple of words here which we have defined before, but I've included them here as well because we will need them in the following lessons and also as a kind of revision for the previous sections. Now, moving on to key investment terms such as stocks, bonds, mutual funds, and retirement accounts. Stocks, bonds, mutual funds, and retirement accounts are some of the key investment terms that you should be familiar with when it comes to investing and personal finance. Before I define these terms, again, what do you think we mean by stocks, bonds, mutual funds, and retirement accounts? Can you guess what those are? What do we mean by them? All right, so let's start by defining the first term, stocks. Stocks, also known as shares or equities, represent ownership in a company. When you purchase a stock, you own a portion of the company and you are entitled to a portion of its profits. Stocks are generally considered riskier investments as their value can fluctuate significantly over time. It can go up or down over time. The next term that we have is bonds. Bonds are a type of fixed income investment where an investor lends money to an entity such as a corporation or government in exchange for interest payments and the return of the principal investments at a set date in the future. Bonds are generally considered less risky than stocks as they offer a fixed rate of return. Next is mutual funds. A mutual fund is an investment vehicle that pools money from many investors to purchase a diversified portfolio of stocks, bonds, or other assets. Mutual funds offer investors the benefit of diversification and professional management, but come with fees and expenses. Retirement accounts. Retirement accounts are investment vehicles designed to help individuals save for retirement. These accounts include employer-sponsored plans such as 401ks, as well as individual retirement accounts, IRAs. Retirement accounts offer tax benefits, but also come with rules and restrictions on when funds can be withdrawn. Understanding these key investment terms will provide a solid foundation for building your knowledge of investment and personal finance. In the following lessons, we will delve deeper into these investment terms and explore how they can be used to build a diversified investment portfolio. So see here on the screen, those are the terms that I defined previously. So stocks, bonds, mutual funds, and retirement accounts. All right, now we're moving on to understanding investment strategies and concepts, which includes risk and return, diversification, and asset allocation. Understanding investment strategies and concepts is essential for making informed investment decisions. Similar to what we did before, what do you think? Can you define any of these terms? If yes, pause the video now, take notes, and compare your answers um, in the following slide. All right, we'll now start by the first term, risk and return. Risk and return are two fundamental concepts in investing. Higher risk investments typically offer higher potential returns, while lower risk investments offer lower potential returns. Investors need to understand their risk tolerance and risk capacity in order to choose investments that align with their investment goals and objectives. The next term is diversification. Diversification is the practice of spreading your investment portfolio across different asset classes, sectors, and geographies to reduce risk. By investing in a variety of different assets, investors can reduce their exposure to any single asset class or investment. Asset allocation. Oh, by the way, before I move on to asset allocation, actually, the previous term diversification, in Arabic, there's like a proverb or a saying, a popular saying. They say, "Don't put all the eggs in one basket," which basically is do not perhaps, like, if you think about it from a financial point of view, it means do not invest in just one area. For example, don't just invest in stocks or real estate. Diversification is good if you want to have a less riskier investment strategy. All right, so asset allocation. Asset allocation is the process of dividing your investment portfolio among different asset classes, such as stocks, bonds, and cash. Asset allocation is important because it can help investors manage risks and achieve their investment objectives. The optimal asset allocation for an investor depends on the risk tolerance, investment goals, and time horizon. Active investing. Active investing involves actively managing a portfolio to try to outperform the market. Passive investing is a little different. So it involves investing in a portfolio that tracks a market index, such as the S&P 500. Both active and passive investing have their pros and cons, and the optimal investment strategy depends on the investor's goals and objectives. By understanding these investment strategies and concepts, investors can make informed decisions about their investment portfolio and achieve their investment goals over time. In the following lessons, we will explore these concepts in greater detail and provide practical tips for implementing them in your investment portfolio. That's if you are going to do any investment. But again, I'm not a financial advisor. The purpose of this course is just to give you an idea about the concepts and the vocabulary that are used within the investment, finance, and accounting industry. But it's not to give you any advice. If you are interested in investment, please do your own research or consult someone who's an expert in investment. To be able to communicate effectively in investing and personal finance, it's important to identify and use key vocabulary such as bull market, bear market, expense ratio, yield, and net worth. If you have invested before in the stock market, you probably have heard about bull market and bear market. Um, but yeah, as as we always do, what do you think these words mean? Take a note of your definitions before I define them in the next slide. There we go. So let's start by the first term here, which is bull market. Bull market refers to a period of rising stock prices and positive investor sentiment, typically characterized by sustained periods of economic growth, low unemployment, and increasing corporate profits. During a bull market, investors are optimistic and typically buy stocks with the expectation of future price increases. Bear market is different, or actually is the opposite. It refers to a period of falling stock prices and negative investor sentiment. This typically occurs during periods of economic recession, high unemployment, and declining corporate profits. During a bear market, investors are pessimistic and tend to sell stocks, which can lead to further declines in prices. Expense ratio. This is the annual fee charged by a mutual fund or exchange traded fund, ETF, to cover its operating expenses. Yield is the return earned on investment, typically expressed as a percentage. Net worth is the total value of an individual's assets minus their liabilities. All right, so this is it for this lesson. Now, the next part of this course is a quiz. So, good luck with it, and I will see you in the following lesson. Hi, this is lesson 2. In this lesson, we will talk about the basics of stocks and bonds, types of stocks and bonds, stock market indices, bond valuation, and after that you will have some exercises and activities to reinforce your learning. Stocks and bonds are two of the most commonly traded financial instruments in the world. They are both used as a way for individuals and businesses to raise capital. Stocks are also known as shares or equities, and they represent ownership in a company. When someone buys a share of stock, they are buying a small piece of ownership in that company. Stockholders have the potential to earn a return on their investment through price appreciation and or dividend payments. And we explained what dividend payments is in previous lessons. Bonds are a type of debt security. When an entity issues a bond, they are essentially borrowing money from investors. The bond issuer promises to pay back the borrowed money or the borrowed amount plus interest at a later date. Bonds typically have a fixed interest rate and a set maturity date. Obviously, understanding the basics of stocks and bonds is important for anyone interested in investing. It's essential to have a clear understanding of the risks and potential rewards associated with each type of investment. Now, I will introduce you to some concepts that you need to understand if you are interested in the investment area. Risk. Stocks are generally considered to be riskier than bonds, as their value can be more volatile. Bondholders have a greater degree of security as they are guaranteed to receive their initial investment plus interest. Return. The potential returns for stocks and bonds can vary widely. Stocks have the potential for greater returns, but also carry more risk. Bonds offer lower potential returns, but are generally considered to be a safer investment. In terms of liquidity, stocks are generally more liquid than bonds, meaning they can be bought and sold more easily. Bonds can be more difficult to sell, particularly if the bond issuer is struggling financially. By understanding the basics of stocks and bonds, Investors can make informed decisions about how to allocate their investment portfolio. Let's have a look at some types of stocks. There are common stocks, preferred stocks, growth stocks, value stocks, and blue chip stocks. Hmm, interesting. What do you think we mean by these? Have you ever heard of these terms before? What do you think they mean and what the difference between them is? The first one that we have here is common stocks. Common stocks represent ownership in a company and provide the shareholder with voting rights and dividends. These are considered riskier than other types of stocks, but they also have the potential to offer higher returns. Preferred stocks. Preferred stocks do not offer voting rights, but provide a fixed dividend payment to shareholders. These are considered less risky than common stocks, but also have lower potential returns. Growth stocks. Growth stocks are stocks of companies that are expected to grow at a rate higher than the market average. These companies usually reinvest their profits back into the business rather than paying dividends. Value stocks. Value stocks are stocks that are considered undervalued by the market and are believed to have the potential for growth. These stocks often have a lower price to earnings ratio than the market average. Blue chip stocks. Blue chip stocks are stocks of large, well-established companies with a long history of stable earnings and dividends. These are considered lower risk stocks. I would like you to do something now. I want you to go online and do a little bit of research on these kind of stocks to see some examples of them. So just go to Google and type in blue chip stocks and see what kind of companies will appear on the Google search. Okay, so we explained types of stocks in the previous slide. Now we'll move on to talk about types of bonds. We've got 4 bonds here that I will explain to you: corporate bonds, government bonds, municipal bonds, high yield bonds. Ever heard of them? What do you think they are? Corporate bonds. Corporate bonds are issued by companies to raise money for various purposes. They are considered riskier than government bonds but offer higher potential returns. Government bonds, on the other hand, are issued by the government to fund public projects and initiatives. They are considered less risky than corporate bonds but offer lower potential returns. Municipal bonds are issued by state and local governments to fund public projects such as schools, hospitals, and infrastructure. They are exempt from federal taxes and sometimes from state and local taxes. High yield bonds, also known as junk bonds, are bonds that are rated below investment grade. They offer higher potential returns but are considered riskier than investment grade bonds. Each type of stock or bond has its own characteristics, risks, and potential return. It's important for investors to understand the differences between each type and to consider their own investment goals and risk tolerance before making any investment decisions. Stock market indices are measures of the performance of a group of stocks traded on a stock exchange. They're typically used to provide a snapshot of the overall performance of the stock market or a specific sector of the market. Some of the most well-known stock market indices include the Dow Jones Industrial Average, the S&P 500, and the Nasdaq Composite. The Dow Jones is a price-weighted index that tracks the performance of 30 large-cap companies listed on the New York Stock Exchange and the Nasdaq. The S&P 500 is a market cap weighted index that tracks the performance of 500 large cap companies listed on the New York Stock Exchange and the Nasdaq. The Nasdaq Composite is a market cap weighted index that tracks the performance of all the companies listed on the Nasdaq Stock Exchange. Investors can use stock market indices to gauge the overall direction of the stock market and to compare the performance of their own portfolios to the broader market. They can also use indices to invest in the market as a whole or to invest in specific sectors of the market represented by an index. Bond valuation. Bond valuation refers to the process of determining the fair value of a bond. It involves calculating the present value of the bond's future cash flows, which include the periodic coupon payment and the principal repayment at maturity. The present value is calculated by discounting the cash flows using the bond's yield to maturity, which is the rate of return an investor would earn if they hold the bonds until maturity. The two main methods used for bond valuation are the present value approach and the relative value approach. The present value approach involves calculating the present value of the bond's cash flows and comparing it to the bond's market price. If the present value is higher than the market price, the bond is undervalued and represents a buying opportunity. If the present value is lower than the market price, the bond is overvalued and represents a selling opportunity. The relative value approach involves comparing the yield of the bond to the yield of similar bonds in the market. And if the bond's yield is higher than that of similar bonds, it may represent a buying opportunity as it offers a higher return relative to its risk. Conversely, if the bond's yield is lower than that of a similar bond, it may represent a selling opportunity as it offers a lower return relative to its risk. Bond valuation is an important concept for investors as it helps them make informed investment decisions and ensure they are paying a fair price for a bond. It also helps issuers determine the appropriate coupon rate to set on a bond based on the prevailing market conditions and the creditworthiness of the issuer. All right, now we talked about bond valuation, we talked about the stocks and the kind of stocks that are there, the type of bonds and type of stocks. Next is a quiz, which will help you to reinforce your learning and check your understanding. So good luck with your quiz, and I will see you in the next lesson. Welcome to Lesson 3, Mutual Funds and Retirement Accounts. In this lesson, we will be exploring mutual funds and retirement accounts, which are two popular investment vehicles. We will delve into the various types of mutual funds and retirement accounts, the advantages and disadvantages of each, contribution limits and rules, and engage in practice exercises to reinforce your learning. By the end of this lesson, you will have a clear understanding of these investment options and how they can help you achieve your financial goals. Mutual funds and retirement accounts are important investment vehicles that can help individuals achieve their financial goals. In this lesson, we will explore the basics of mutual funds and retirement accounts. First, we will discuss what mutual funds are and how they work. Mutual funds are investment vehicles that pool money from multiple investors to purchase a diversified portfolio of stocks, bonds, or other securities. This diversification can help to spread out risk and potentially increase returns. We will also look at the different types of mutual funds, including equity funds, fixed income funds, and balanced funds. Next, we will delve into retirement accounts such as individual retirement accounts, IRAs, and employer-sponsored plans like 401ks. We will discuss the benefits of investing in these types of accounting, including tax advantages and employer contributions. We will also review contribution limits and withdrawal rules so individuals can make informed decisions about how much to invest and when to access their funds. Finally, we will examine the advantages and disadvantages of investing in mutual funds and retirement account. We will weigh the benefits of diversification and personal management against the costs of fees and expenses. Understanding mutual funds and retirement accounts is an important part of personal finance and investing. Mutual funds, as we said earlier, are investment vehicles which pool money from individual investors to invest in a diversified portfolio of stocks, bonds, and other securities, whereas retirement accounts, on the other hand, are savings plans designed to help individuals save for their retirement years. These accounts offer tax advantages which can help individuals save more money over time. There are several types of mutual funds, including equity funds, bond funds, index funds, and sector funds. Each type of fund has different investment strategies and risk levels. Similarly, there are various types of retirement accounts, such as 401k plans, individual retirement accounts, and Roth IRAs. Each type of account has its own contribution limits and rules. Mutual funds and retirement accounts have their own advantages and disadvantages. For example, mutual funds offer diversification and professional management, but also come with management fees and other expenses. Retirement accounts offer tax benefits, but may have penalties for early withdrawal and contribution limits. It's important to understand the contribution limits and rules for each type of account, as well as the investment strategies and risks associated with mutual funds. Okay, so let's look at some of the advantages and disadvantages of mutual funds. Advantages of mutual funds includes diversification. So mutual funds offer investors the ability to invest in a diverse range of assets, reducing the overall risk. Professional management. Also, again, mutual funds are managed by investment professionals who make investment decisions on behalf of the investors. Affordability. Mutual funds typically have low minimum investment requirements, making them accessible to a wide range of investors. Liquidity. Mutual funds can be bought and sold easily, and investors can typically access their funds within a few days. Variety. Mutual funds come in a wide variety of types and styles, allowing investors to choose funds that align with their investment goals and risk tolerance. Okay, let's look at the disadvantages of mutual funds. Fees. Mutual funds charge fees to cover the costs of management and administration, which can eat into investment returns. Limit control. Investors in mutual funds have little control over investment decisions, which are made by the fund managers. Market risk. Like any investment, mutual funds are subject to market risk, and investors may experience losses during market downturns. Potential for underperformance. Not all mutual funds perform well, and investors may be disappointed with returns that do not meet their expectations. Now, let's look at the retirement account advantages and disadvantages. We'll start first by the advantages. One of the advantages is tax benefits. So, retirement accounts offer tax advantages such as the ability to contribute pre tax income and defer taxes on investment gains until retirement. Savings discipline. Retirement accounts can help investors save for the future by providing a structured way to contribute on a regular basis. Employer contributions. Some retirement accounts, such as 401ks, offer employer contributions, which can boost retirement savings. Investment options. Retirement accounts offer a variety of investment options, including mutual funds, stocks, and bonds, allowing investors to tailor their investments to their goals and risk tolerance. Now that we looked at the advantages, let's look at the disadvantages. Contribution limits. Retirement accounts have contribution limits that may be lower than some investors' savings goals. Withdrawal penalties. Early withdrawals from retirement accounts can result in significant penalties and taxes. Limited access. Retirement accounts are designed for long-term savings, and access to funds before retirement may be limited or restricted. Market risk. Like any investment, retirement accounts are subject to market risks, and investors may experience losses during market downturns. There are some contribution limits and rules. So, contributions to retirement accounts are typically subject to annual limits set by the IRS. For example, the contribution limit, according to the Internal Revenue Service, for traditional and Roth IRAs in 2021 is $6,000 or $7,000 for those aged 50 or older. Contribution limits for employer-sponsored retirement plans such as 401ks and 403bs are generally higher, with a limit of $19,500 for 2021 or $26,000 for those aged 50 or older. It's important to note that contribution limits and rules may vary depending on the specific type of retirement account and individual circumstances. Additionally, there may be penalties for exceeding contribution limits or failing to meet certain requirements, so it's important to consult with a financial advisor or tax professional before making contributions to a retirement account. As I said earlier, this is not to give you any finance or investment advice. This course is basically just to give you the knowledge about investment, finance, and accounting in general, with obviously focus on understanding the terms and the vocabulary, the terminology that are within this industry. Hi, and welcome to Lesson 4, Investment Portfolio Management. Lesson 4 focuses on investment portfolio management, which involves creating and maintaining a diversified investment portfolio that aligns with an individual's investment goals, risk tolerance, and time horizon. Effective portfolio management requires a thorough understanding of investment strategies as well as an ability to evaluate and adjust investment portfolios to ensure they remain aligned with the investor's goals and objectives. Lesson 4 Objectives. In this lesson, we will focus on understanding portfolio management, evaluating portfolio performance, rebalancing portfolio, and developing an investment plan. In addition to some practice exercises and activities to reinforce your learning. So let's get started. Understanding portfolio management. Here we will focus on two main things: portfolio management and diversification. The first thing, portfolio management, refers to the art and science of making decisions about investment mix and policy, matching investments to objectives, asset allocation for individuals and institutions, and balancing risk against performance. It's an ongoing process of decision making and is essential for maximizing returns and minimizing risk. Portfolio management involves selecting investments and monitoring them regularly to ensure they are meeting the investment objectives. To understand portfolio management, one needs to understand the concept of diversification, which takes us to the second main important thing here, which is diversification. And it involves investing in a variety of securities to spread the risk. This helps to reduce the impact of any one security or sector on the overall portfolio performance. By diversifying the portfolio, investors can reduce their risk exposure and increase the potential for returns. Investors can manage their portfolios by themselves or hire a professional portfolio manager to do it for them. In either case, it's important to have a clear understanding of investment objectives, risk tolerance, and time horizon for investment to create a suitable portfolio. Evaluating portfolio performance is an essential aspect of investment portfolio management. It involves assessing how well an investor's portfolio is performing against a set of benchmarks or objectives. This evaluation is critical in determining whether the portfolio is meeting investors' goals, such as generating income, capital growth, or both. To evaluate portfolio performance, investors need to consider several factors, including the return on investment, risk level, and the correlation between different assets in the portfolio. They can use various metrics such as the Sharpe ratio, Trainer ratio, and Jensen's alpha to determine portfolio performance. Moreover, investors can also use a benchmark to evaluate the performance of their portfolio. A benchmark is a standard against which portfolio performance can be compared. Common benchmarks include market indices such as the S&P 500 or a bond index such as the Barclays US Aggregate Bond Index. By evaluating portfolio performance regularly, investors can make informed decisions on whether to make changes to their investment strategy, such as rebalancing the portfolio or adjusting their asset allocation. Rebalancing a portfolio is the process of adjusting the asset allocation of an investment portfolio to maintain the desired level of risk and return. Over time, market fluctuations can cause the percentage of assets in a portfolio to shift from their original allocation, which can result in an unintended risk exposure. By rebalancing, an investor can bring their portfolio back to its intended allocation, which can help manage risk and potentially improve long-term returns. There are a few different methods for rebalancing a portfolio, but the most common approach is to periodically review the portfolio and adjust the asset allocation as necessary. This might involve selling some assets that have increased in value and using the proceeds to purchase other assets that have lagged behind. Alternatively, an investor might choose to direct new contributions into assets that have fallen below their target allocation rather than investing in the assets that have performed well. The frequency with which an investor should rebalance their portfolio depends on a variety of factors, including their investment goals, risk tolerance, and time horizon. Some investors may choose to rebalance annually, while others may do so more frequently or less frequently. It's important to strike a balance between maintaining the intended level of risk and return while also minimizing transaction costs and tax implications associated with frequent trading. Overall, rebalancing is an important aspect of portfolio management that can help investors stay on track towards their investment goals. Developing an investment plan. Developing an investment plan is an important step in managing your portfolio effectively. An investment plan is a roadmap that outlines your investment objectives, risk tolerance, asset allocation, and the strategies that you will use to achieve your financial goals. Here are some steps that can help you develop an investment plan. 1. Set your investment goals. Before you start investing, you should determine your financial goals. This will help you create a roadmap that will guide your investment decisions. 2. Determine your risk tolerance. Every investment carries some level of risk, and it's important to determine your risk tolerance before you start investing. Your risk tolerance will depend on factors such as your age, financial situation, and investment goals. 3. Choose your asset allocation. Asset allocation is the process of dividing your portfolio among different asset classes such as stocks, bonds, and cash. The goal of asset allocation is to create a portfolio that is aligned with your investment goals and risk tolerance. 4. Select your investment. Once you've determined your asset allocation, you can start selecting the specific investments that will make up your portfolio. This may include stocks, bonds, mutual funds, exchange traded funds, ETFs, and other investment vehicles. And the last thing is to monitor and adjust your portfolio. Your investment plan should be reviewed and adjusted periodically to ensure that it remains aligned with your investment goals and risk tolerance. By following these steps, you can develop an investment plan that is tailored to your specific financial situation and investment goals. A well-designed investment plan can help you achieve your financial objectives and manage your portfolio effectively. Next, you have a quiz and an assignment to work on. By completing both tasks, you will reinforce your learning and they will give you a chance not only to test your knowledge but also to practice what you've learned so far. I'm sure you will do an amazing job. The next section is section 4, and in this section we will look at corporate finance. We'll talk about mergers, acquisitions, corporate restructuring, and finance. Good luck with your quiz and an assignment, and I will see you in the next section. Hi, and welcome to Lesson 4, Investment Portfolio Management. Lesson 4 focuses on investment portfolio management, which involves creating and maintaining a diversified investment portfolio that aligns with an individual's investment goals, risk tolerance, and time horizon. Effective portfolio management requires a thorough understanding of investment strategies as well as an ability to evaluate and adjust investment portfolios to ensure they remain aligned with the investor's goals and objectives. Lesson 4 Objectives. In this lesson, we will focus on understanding portfolio management, evaluating portfolio performance, rebalancing portfolio, and developing an investment plan. In addition to some practice exercises and activities to reinforce your learning. So let's get started. Understanding portfolio management, here we will focus on two main things, portfolio management and diversification. The first thing, portfolio management, refers to the art and science of making decisions about investment mix and policy, matching investments to objectives, asset allocation for individuals and institutions, and balancing risk against performance. It's an ongoing process of decision making and is essential for maximizing returns and minimizing risk. Portfolio management involves selecting investments and monitoring them regularly to ensure they are meeting the investment objectives. To understand portfolio management, one needs to understand the concept of diversification, which takes us to the second main important thing here, which is diversification. And it involves investing in a variety of securities to spread the risk. This helps to reduce the impact of any one security or sector on the overall portfolio performance. By diversifying the portfolio, investors can reduce their risk exposure and increase the potential for returns. Investors can manage their portfolios by themselves or hire a professional portfolio manager to do it for them. In either case, it's important to have a clear understanding of investment objectives, risk tolerance, and time horizon for investment to create a suitable portfolio. Evaluating portfolio performance is an essential aspect of investment portfolio management. It involves assessing how well an investor's portfolio is performing against a set of benchmarks or objectives. This evaluation is critical in determining whether the portfolio is meeting investors' goals, such as generating income, capital growth, or both. To evaluate portfolio performance, investors need to consider several factors, including the return on investment, risk level, and the correlation between different assets in the portfolio. They can use various metrics such as the Sharpe ratio, Trainer ratio, and Jensen's alpha to determine portfolio performance. Moreover, investors can also use a benchmark to evaluate the performance of their portfolio. A benchmark is a standard against which portfolio performance can be compared. Common benchmarks include market indices such as the S&P 500 or a bond index such as the Barclays US Aggregate Bond Index. By evaluating portfolio performance regularly, investors can make informed decisions on whether to make changes to their investment strategy, such as rebalancing the portfolio or adjusting their asset allocation. Rebalancing a portfolio is the process of adjusting the asset allocation of an investment portfolio to maintain the desired level of risk and return. Over time, market fluctuations can cause the percentage of assets in a portfolio to shift from their original allocation, which can result in an unintended risk exposure. By rebalancing, an investor can bring their portfolio back to its intended allocation, which can help manage risk and potentially improve long-term returns. There are a few different methods for rebalancing a portfolio, but the most common approach is to periodically review the portfolio and adjust the asset allocation as necessary. This might involve selling some assets that have increased in value and using the proceeds to purchase other assets that have lagged behind. Alternatively, an investor might choose to direct new contributions into assets that have fallen below their target allocation rather than investing in the assets that have performed well. The frequency with which an investor should rebalance their portfolio depends on a variety of factors, including their investment goals, risk tolerance, and time horizon. Some investors may choose to rebalance annually, while others may do so more frequently or less frequently. It's important to strike a balance between maintaining the intended level of risk and return while also minimizing transaction costs and tax implications associated with frequent trading. Overall, rebalancing is an important aspect of portfolio management that can help investors stay on track towards their investment goals. Developing an investment plan. Developing an investment plan is an important step in managing your portfolio effectively. An investment plan is a roadmap that outlines your investment objectives, risk tolerance, asset allocation, and the strategies that you will use to achieve your financial goals. Here are some steps that can help you develop an investment plan. 1. Set your investment goals. Before you start investing, you should determine your financial goals. This will help you create a roadmap that will guide your investment decisions. 2. Determine your risk tolerance. Every investment carries some level of risk, and it's important to determine your risk tolerance before you start investing. Your risk tolerance will depend on factors such as your age, financial situation, and investment goals. 3. Choose your asset allocation. Asset allocation is the process of dividing your portfolio among different asset classes such as stocks, bonds, and cash. The goal of asset allocation is to create a portfolio that is aligned with your investment goals and risk tolerance. 4. Select your investment. Once you've determined your asset allocation, you can start selecting the specific investments that will make up your portfolio. This may include stocks, bonds, mutual funds, exchange-traded funds, ETFs, and other investment vehicles. And the last thing is to monitor and adjust your portfolio. Your investment plan should be reviewed and adjusted periodically to ensure that it remains aligned with your investment goals and risk tolerance. By following these steps, you can develop an investment plan that is tailored to your specific financial situation and investment goals. A well-designed investment plan can help you achieve your financial objectives and manage your portfolio effectively. Next, you have a quiz and an assignment to work on. By completing both tasks, you will reinforce your learning and they will give you a chance not only to test your knowledge but also to practice what you've learned so far. I'm sure you will do an amazing job, so good luck. The next section is section 4. In this section, we will focus on corporate finance and we'll talk about mergers, acquisition, and corporate restructuring and finance. So, see you soon. Well done for completing the investment and personal finance section. I hope that you found the course informative and engaging. During the past 4 lessons, you've explored key investment concepts such as risk and return, diversification, asset allocation, and portfolio management. Through practice exercises and activities, you've gained practical knowledge of how to use investment vocabulary and strategies to effectively manage your personal finances. As you move forward, remember that investment and personal finance are ongoing processes that require continuous learning and effort. I encourage you to continue exploring investment concepts and strategies to achieve your personal financial goals. I hope that you've enjoyed this section and found it valuable. And if you have any questions or feedback, please do not hesitate to reach out to me. You've done an amazing job getting to this section so far, so well done for completing section 1, 2, and 3. So, section 4. In this section, we will focus more on corporate finance, mergers, acquisitions, corporate restructuring, and finance. There will be vocabulary related to corporate finance, including mergers, acquisitions, corporate structuring, and financial planning. We will also help you understand corporate finance concepts, including capital structure, valuation, and financial modeling. And you will identify a new key vocabulary related to corporate finance. And as usual, there will be practice exercises and activities for you to reinforce your learning. So let's get started with lesson 1, Introduction to Corporate Finance Vocabulary. Lesson 1, Introduction to Corporate Finance Vocabulary. Corporate finance involves managing a company's financial resources to achieve its goals, including increasing shareholder value and maximizing profitability. Here are some key terms related to corporate finance. If you're trying to work on your pronunciation and use this course to improve your vocabulary and pronunciation skills, I'm going to say each term slowly so that you can notice how I pronounce them. And I want you to pause after each term and pronounce it after me. Say it out loud so that you can improve your pronunciation if that's something that you want to do during this course. All right, so let's go. Capital structure, valuation, financial modeling, mergers and acquisitions, due diligence, leveraged buyout, corporate restructuring, financial planning, debt financing, equity financing, initial public offering, working capital, capital expenditure, operating expenses, EBITDA. We explored this before. We defined EBITDA earlier. ROI, return on investment, dividend, financial statement. All right, you might be familiar with a few of these because we've explained them before. So before we talked about ROI, EBITDA, dividend, and financial statements. We defined them before, so you should already know what these are. So let's define them one by one in the next slide. All right, so let's define each term on its own. Capital structure. This is the way a company finances its operations through a combination of equity and debt. A company's capital structure can impact its financial stability, risk profile, and cost of capital. Valuation. The process of determining the value of a company or asset, often used in mergers and acquisitions to determine a fair price. Valuation can be based on a variety of factors, including financial metrics, industry trends, and market conditions. Financial modeling, which is the process of creating a mathematical representation of a company's financial situation to help make informed business decisions. Financial modeling can help companies project future cash flows, assess risk, and analyze potential investments. Mergers and acquisitions. This is the process of combining two or more companies into a single entity or acquiring another company. M&A, mergers and acquisitions, can be motivated by a desire to gain market share, expand into new markets, or achieve other strategic objectives. Due diligence, the process of researching and analyzing a company or business prior to a merger or acquisition. Leveraged buyout. This is the acquisition of a company using a significant amount of borrowed money to finance the purchase. LBOs are often used to acquire companies with high growth potential or to take publicly traded companies private. Corporate restructuring. This is the process of reorganizing a company's structure or operations to improve its performance or financial stability. Corporate restructuring can involve change to a company's management, product lines, organizational structure, or other factors. Financial planning, which is the process of creating a roadmap to help a company achieve its financial goals, including budgeting, forecasting, and analysis of financial statements. Financial planning can help companies make informed decisions about investments, expenses, and growth strategies. Debt financing. This is raising capital through borrowing money from external resources, such as banks or bond markets. Equity financing. This is raising capital through the sale of company stocks to investors. Initial public offering, IPO. This is the first sale of stock by a private company to the public. Working capital. This is the amount of cash and other assets a company has available to meet its short-term financial obligations. Capital expenditure. The money a company spends on long-term assets such as equipment, property, or infrastructure. Operating expenses, which also refer to OPEX. This is the ongoing costs for running a business, such as salaries, rent, and utilities. EBITDA, it's an acronym, and we talked about this before. Earnings before interest, taxes, depreciation, and amortization. This is a financial metric that represents a company's profitability before accounting for non-operating expenses. Return on investment, again, that's one of the things we explained before, and it's the measure of how much profit or return an investment generates relative to its cost. Dividend, this is the portion of a company's profit paid out to shareholders as a return on their investment. Financial statement, usually is a report that provides information about a company's financial performance, including income statements, balance sheets, and cash flow statements. These are some key terms related to corporate finance, and there are many more to explore. By understanding these concepts and vocabulary, you can better understand how companies make financial decisions and achieve their goals. Next, you'll have a quiz to test your knowledge, so good luck with it, and I will see you in lesson 2. Lesson 2, Understanding Corporate Finance Concepts. Lesson 2, Understanding Corporate Finance Concepts. Learning outcomes of this lesson include an overview of capital structure, including debt and equity financing, explanation of valuation methods and how they are used in corporate finance, introduction to financial modeling and its importance in corporate finance, and as usual, there are practice exercises for you to practice and reinforce your learning and develop skills in applying those concepts. Capital structure refers to the way a company finances its operations through a combination of debt and equity financing. Debt financing involves borrowing money from lenders or issuing bonds, which must be repaid with interest. Equity financing, on the other hand, involves selling ownership shares in the company to investors in exchange for capital. A company's capital structure can have significant implications for its financial stability, risk profile, and cost of capital. For example, a company that relies heavily on debt financing may have higher interest payments, making it more vulnerable to changes in interest rates. On the other hand, a company that relies primarily on equity financing may have a higher cost of capital as investors expect a higher return on their investment in exchange for the increased risk. Finding the right balance between debt and equity financing is a key consideration for companies when establishing their capital structure. Factors such as the company's growth potential, cash flow, and risk tolerance will all play a role in determining the optimal mix of debt and equity financing. Alright, here I'll provide an explanation of valuation methods and how they are used in corporate finance. Valuation is the process of determining the value of a company or asset. In corporate finance, valuation is often used in mergers and acquisitions to determine a fair price for the target company. There are several methods of valuation that can be used, depending on the nature of the company or asset being valued and the purpose of the valuation. Some common valuation methods include discounted cash flow, DCF analysis, comparable company analysis, CCA, precedent transaction analysis, PTA, asset-based valuation. So those are some of the common valuation methods. Let's define them in the next slide together to know more about them. Discounted cash flow, DCF. This method involves estimating the future cash flows that the company is expected to generate and discounting them back to their present value using a discount rate. This method is commonly used to value companies that have predictable cash flows and steady growth rates. Comparable company analysis, CCA. This method involves comparing the target company to other similar companies that have already been valued. The value of the target company is then estimated based on the multiple such as price to earning ratio that are used to value the comparable companies. Precedent transaction analysis, PTA. This method involves analyzing the prices paid for similar companies in previous mergers and acquisitions. The value of the target company is then estimated based on the prices paid for the comparable companies. Asset-based valuation, and this method involves estimating the value of the company's assets, such as its property, plant, and equipment, and subtracting its liabilities. This method is commonly used for companies that have a significant amount of tangible assets. Valuation methods are important in corporate finance because they provide a way to estimate the fair value of a company or asset. This information is essential for companies that are considering mergers and acquisitions, as it helps them determine whether the target company is worth the price being asked. Valuation can also be useful for companies that are considering raising capital, as it helps them determine the value of their shares or assets. Here, I will introduce you to financial modeling and its importance in corporate finance. We'll talk about three main things: financial modeling, financial models, and the importance of financial modeling. So what is financial modeling? Financial modeling is the process of creating a mathematical representation of a company's financial situation. Financial models are used to help make informed business decisions by projecting future cash flows, assessing risks, and analyzing potential investments. In corporate finance, financial modeling is an essential tool that helps companies evaluate the financial implications of different business decisions. Financial modeling typically involves creating a spreadsheet that uses various financial and accounting formulas to estimate future cash flows, profits, and other financial metrics. The model may also incorporate data from external sources, such as industry trends or economic forecasts. Financial models can be used to analyze a wide range of financial scenarios, such as forecasting future revenues, estimating expenses, and assessing the impact of different financing options. For example, a company might use a financial model to evaluate the financial impact of launching a new product line or acquiring a competitor. The importance of financial modeling in corporate finance cannot be overstated. By creating a model that accurately reflects a company's financial situation, decision makers can make informed choices about how to allocate resources, which projects to pursue, and how to manage risk. A financial model can also help a company assess the feasibility of potential investments and develop a clear understanding of the expected return on investment. Overall, financial modeling is an essential tool for companies that want to make informed financial decisions. By using financial models to evaluate different scenarios and test assumptions, companies can improve their chances of success and avoid costly mistakes. This was a long one, I know. Next, you have a quiz so that you can apply what you've learned so far. So, good luck, and I will see you in lesson 3. Hi, this is lesson 3, and here we will focus more on mergers, acquisitions, and corporate restructuring. So I'll provide you with an introduction to mergers, acquisitions, including types of mergers and the process of due diligence. I will also explain the leveraged buyouts and their impact on corporate finance. We will have an overview of corporate restructuring and its importance in improving a company's financial performance, and your favorite part, which is the exercises to practice and apply the things that you've learned in the course. Okay. Mergers and acquisitions are transactions in which companies combine their operations or one company acquires another. M&A transactions are common in the business world and are usually done to achieve strategic objectives such as gaining market share, diversifying operations, or expanding into new markets. There are different types of mergers, and here I will talk about three different types. The first one is horizontal merger, and this occurs when two companies in the same industry combine their operations. For example, if two pharmaceutical companies merge, it would be a horizontal merger. The second type is vertical merger, and this occurs when two companies in different stages of the same supply chain combine their operations. For example, if a manufacturer acquires a supplier, it would be a vertical merger. Conglomerate merger, that's the third type, occurs when two companies in unrelated industries combine their operations. For example, if a technology company acquires a food and beverage company, it would be a conglomerate merger. Here we'll talk about the process of due diligence. Due diligence is the process of investigating a company's financial, legal, and operational information before a merger or acquisition. The purpose of due diligence is to identify any risks or potential issues that could impact the success of the transaction. The purpose of due diligence typically includes the following steps. 1. Financial due diligence. This involves reviewing a company's financial statements, tax returns, and other financial records to evaluate its financial health. 2. Legal due diligence. This involves reviewing a company's legal documents, such as contracts, licenses, and litigation records to identify any legal risks. 3. Operational due diligence. This involves reviewing a company's operational processes and procedures to identify any inefficiencies or potential areas for improvement. Number 4, cultural due diligence. And this involves assessing the compatibility of the two companies' cultures to ensure a successful integration. Once the due diligence process is complete, the acquiring company can make an informed decision about whether to proceed with the transaction and at what price. Explanation of a leveraged buyouts and their impact on corporate finance. We defined a leveraged buyout earlier, and we said that it's a financial transaction in which a company is acquired using a large amount of debt, typically from a combination of banks and other lenders. The debt is usually secured by the assets of the acquired company, and the acquiring company often uses the cash flow generated by the acquired company to repay the debt. LBOs are often used by private equity firms to acquire control of a company, often with the intention of selling it for a profit after a period of time. LBOs are also used by management teams or other investors to acquire a company that is not publicly traded or to take a public company private. The impact of leveraged buyouts on corporate finance can be significant. On the positive side, An LBO can provide a source of capital for a company that might not be able to obtain financing through traditional channels. It can also provide incentives for managers to focus on improving the company's performance, since their compensation may be tied to the success of the LBO. There are also some downsides here, however, there are also potential downsides to an LBO. One of the main risks is the increased debt burden that comes with the transaction. The company will have to serve the debt, which can be a strain on cash flow and limit the company's ability to invest in growth opportunities. Additionally, the debt may limit the company's flexibility in responding to changing market conditions or strategic opportunities. Another potential risk of an LBO is that the company's credit rating may be downgraded, making it more difficult and expensive to obtain financing in the future. Finally, if the company's performance doesn't meet expectations, the acquiring company may not be able to repay the debt, which could lead to bankruptcy. Here, I'll provide you with an overview of corporate restructuring and its importance in improving a company's financial performance. Before I delve into this, if you know what corporate structuring is, if you know the importance of corporate restructuring, or the challenges and important opportunities that restructuring can bring to a company, pause the video now, take a minute to think about these, perhaps even take notes, and then compare them to what I will say about him. All right? Corporate restructuring refers to the process of making significant changes to a company's organizational structure, operations, or ownership in order to improve its financial performance. Restructuring can involve a variety of actions, including mergers and acquisitions, divestitures, spin-offs, layoffs, and changes in strategy or business model. The importance of a corporate restructuring in improving a company's financial performance is significant. When a company is struggling financially, restructuring can provide an opportunity to reduce costs, increase efficiency, and focus on core competencies. For example, a company may divest non-core assets or business units that are not performing well in order to free up resources and focus on its core strength. Corporate restructuring can also help a company adapt to changes in the business environment or competitive landscape. For example, a company may need to change its strategy or business model in order to remain competitive, or it may need to recognize its operations to better align with changing customer needs. Restructuring can also provide an opportunity to address issues with a company's capital structure, such as excessive debt or inefficient use of capital. For example, a company may use the proceeds from a divestiture to pay down debt, or it may issue new equity to raise capital for growth opportunities. In summary, corporate restructuring is an important tool for improving a company's financial performance. By making strategic changes to the company's operations, structure, or ownership, companies can reduce costs, increase efficiency, and focus on core strength, ultimately improving their competitiveness and long-term success. However, restructuring can also be complex and risky, and companies must carefully evaluate the potential risks and benefits before proceeding with any restructuring initiatives. Next, you have a quiz to test your knowledge so far. Good luck with it, and I will see you in lesson 4. Hi, we now reached lesson 4 in section 4. Lesson 4 is about financial planning. In this lesson, I'll provide you with an overview of financial planning and its importance in achieving a company's goal. I'll also provide you with an introduction to financial statements and the role in financial planning. And you will have some exercises and activities to reinforce your learning and develop skills in using financial statements for planning and analysis. Here, I'll provide you with an overview of financial planning and its importance in achieving a company's goals. Before I do this, can I ask you to pause the video now for a minute and think about the points on the screen? What is financial planning? What are financial planning goals? And what is financial planning importance for companies? Okay. Financial planning is the process of creating a roadmap for a company's financial future by establishing goals, identifying resources, and developing strategies to achieve those goals. Effective financial planning is critical for a company's success as it helps to ensure that the company is well positioned to achieve its goals and objectives. One of the primary goals of financial planning is to maximize the value of the company's assets and resources. This involves identifying the company's strengths and weaknesses, assessing its financial position, and developing strategies to leverage its productivity and efficiency, or it may focus on reducing costs in order to improve profitability. Another important goal of financial planning is to manage risk. By identifying potential risks and developing strategies to mitigate those risks, companies can reduce their exposure to financial loss and protect their assets. For example, a company may develop a plan to diversify its product line or customer base in order to reduce the risk of dependence on a single product or customer. Financial planning is also important for companies that are looking to grow or expand. By developing a comprehensive plan for growth, companies can ensure that they have the resources and strategies in place to support their expansion efforts. This may involve developing a plan to raise capital, identifying potential acquisition targets, or developing strategies to enter new markets or expand existing operations. In summary, financial planning is a critical component of a company's success. By establishing clear goals, identifying resources, and developing strategies to achieve those goals, companies can maximize the value of their assets, manage risks, and position themselves for growth and success. However, financial planning can be complex and challenging, and companies must be prepared to adapt their plans as market conditions and business environments change. Here we will have a bit of an introduction to financial statements and the role in financial planning. We talked about financial statements before, we defined them previously. We also talked about the income statements, the balance sheet, and the cash flow statements. So try to take a minute here and try to review them if you don't remember them um, but I will define them in the next slide anyway. Financial statements are reports that provide information about a company's financial performance and position. The three main financial statements are the income statements, balance sheet, and cash flow statement. Financial statements play an essential role in financial planning as they provide valuable information that can be used to assess a company's financial health, identify areas for improvement, and make informed business decisions. Financial statements are also used to evaluate a company's performance relative to industry benchmarks and competitors. This information can be used to identify areas where a company may be underperforming and develop strategies to improve performance. The income statement, also known as the profit and loss statement, provides information about a company's revenue, expenses, and net income over a specific period. This statement is used to assess a company's profitability and identify areas where expenses may be reduced or revenue increased. The balance sheet provides information about a company's assets, liabilities, and equity at a specific point in time. This statement is used to assess a company's financial position and determine its ability to meet its financial obligations. The cash flow statement provides information about a company's cash inflows and outflows over a specific period. This statement is used to assess a company's liquidity and determine its ability to generate cash to meet its financial obligations. Overall, financial statements are essential tools for financial planning as they provide critical information that can be used to assess a company's financial health, identify areas for improvement, and make informed business decisions. Companies must ensure that their financial statements are accurate, timely, and reliable to support effective financial planning and decisions. What's next? Okay, so next you have an assignment to work on. By completing this assignment, you will reinforce your learning and it will give you a chance not only to test your knowledge, but also to practice what you've learned so far. I'm sure you will do an amazing job, so good luck with it. The next section is section 5, which is a quick wrap up for the course. Well done for getting to this stage. You've done an amazing job.
Congratulations on completing this finance course. It's been a pleasure to guide you through this journey and see your progress along the way. I hope that you found the course informative and engaging and that it has given you a better understanding of financial concepts and vocabulary. These are important skills that will serve you well in both your personal and professional lives. Remember that learning is a lifelong process and there is always more to discover and explore. Continue to stay curious and seek out opportunities to expand your knowledge and skills. Thank you for your dedication and hard work throughout this course. I know it wasn't easy. I wish you all the best in your future and I hope that you continue to grow and thrive in your personal and professional lives. Again, thank you for joining us in this course. My name is Imad and I hope to see you soon in future courses.